Welcome to 5-Minute Accounting Concepts. Today we're going to be talking about the capital gains deduction. This video isn't meant to be tax advice. It's geared towards students who have to do this for school. So the capital gains deduction is a Division C deduction available to individuals. What it does is it allows individuals to deduct capital gains incurred on the disposition of certain types of property. This includes qualified farming and fishing property, as well as qualified small business corporation shares. We're going to focus on QSBC shares because this comes up more frequently. There is a lifetime limit to the amount that you can deduct under 110.6, and that is $835,716 in capital gains. So the amount of taxable capital gains that you can deduct is half of that. This limit does change from year to year, so it's worth checking with your professor or someone who has an updated tax act what the amount is. So the first step is to figure out whether the shares that were disposed of meet the definition of a QSBC share. So you can find the definition in section 110.6 sub 1, which is the definitions part of the capital gains deduction. And basically there are four tests outlined in paragraph A, B, C, and D. And you have to meet A, B, and either C or D. Basically, A says that the share has to be a small business corporation share. You can find the definition for that in 248 sub 1. B is the holding period test, and then C is the basic asset test, and D is the modified basic asset test. And again, you can meet either C or D and still qualify. So our next step is to calculate the annual gains limit. You can find this again in 110.6 sub 1. Now we need to calculate an annual gains limit for each year for which the individual has this sort of investment activity. So for example, if they sold investments in 2009, 2015, and now it's 2017, we would need an annual gains limit for each one of those years. Remember again, for simplicity's sake, we're assuming there's no activity related to qualified farming or fishing property. So they give us this formula, A minus B, starting with A. A is the lesser of our net taxable capital gains for the year, and what our net taxable capital gains for the year would be if we only considered capital gains and capital losses from QSBC shares. An important thing to remember here is that if we have a loss on QSBC shares, it can either be a capital loss or a business investment loss or a combination of the two, depending on whether part of it is disallowed. So first we have to go to section 39.9 to figure out what part is a bill and what part is a capital loss and belongs up here. So again, big A is the lesser of little a and little b. Moving on to B. B is the total of little a and little b. Little a here is our net capital loss carry forwards for the year under 111.1b, minus our net taxable capital gains minus whatever value we got up here for A. So again, 1 minus 2 gives us little a, and then little b over here is just our A bills for the year. And then big B, as we said, is the sum of little a and little b. And then, of course, our annual gains limit is big A minus big B. Our next step is to calculate the cumulative gains limit. We need to do that for the current year, which is the year in which we're trying to calculate the capital gains deduction. You can find this again in 110.6 sub 1. So the basic outline of the calculation here is A minus B minus D minus E. We can ignore C because it doesn't really come up. It only relates to 1985. So for A and B, we need to go back to our annual gains limit calculations that we just did. So you recall that the basic formula for that was big A minus big B. So A here is the sum of all the big A's from our annual gains limit calculations. And from that we subtract the sum of all the B's, and we also subtract the previous capital gains deductions that we've taken. Because you remember there is a lifetime limit on the amount you can claim under this section. And finally, we subtract the cumulative net investment loss up to the end of the current year. So the cumulative net investment loss is also defined in this section. And what it is the sum of all the individual's investment expenses minus their investment income. And this is for the period from 1988 to whatever the current year is, because the legislation only came in 1987. The cumulative net investment loss includes things like net interest losses, net rental losses, that sort of thing. So our final step here is to actually calculate the capital gains deduction. And so for that, you're going to have to turn to 110.6 sub 2.1. The calculation here is the least of these four amounts. So starting with A actually directs us over to 110.6 sub 2, which is our calculation for capital gains deduction on qualified farm property, but we're just taking the same formula that they have up here. So what this formula basically says is you take $417,858, which is the lifetime limit for an individual expressed in taxable capital gains, and from that you subtract the previous capital gains deductions that you've taken under this section. The formula looks a little bit more complicated than that, but all A through E are really doing are adjusting for the different inclusion rates that have been historically for capital gains. So right now it's 50%, but it's been 3/4, it's been 2/3 in the past. So you're just adjusting those and treating them as though it's always been 50%. So that's A. Now B is the cumulative gains limit, which we previously calculated. C is the annual gains limit for the year. And D is our net taxable capital gains if we only considered capital gains and capital losses from QSBC shares. And yeah, so the least of those four amounts is your capital gains deduction. So that concludes this video. Thanks for watching. Please like and subscribe, and feel free to comment any ideas for videos or suggestions that you might have. Thanks.